This is wheat during the Ukrainian war. And you can see wheat was super quiet. And then as we started to have rumors of the war and then the war broke out, you could see the future spread in wheat just exploded. But what's interesting is you see price makes this violent top and it's confirmed by the future spreads. The future spreads just collapse. And then you can notice it puts in this violent top, but then it trades in a range for a couple months and while future spreads continue to drop. Then price tries to rally, spreads rally a little bit, but not nearly as much. The spreads get nowhere near the highs. And so now we get a price action turn here that's again confirmed by the future spread, and then the market just goes relentlessly down for several months, again backed by the future spread. If you're looking to take your trading skills to the next level, be sure to join the Red Pill Tribe community. It's a private trading community that's free for a limited time where traders can connect, learn, and grow together. Click the link in the pinned comment below to join us today and get access to our Trader Tribes community, our live chat room, market news, monthly contests, and much more. I'll see you in the Red Pill Tribe. The market's lie detector, the hidden truth in future spreads. Future spreads are one of the most important factors in being able to successfully trade futures. This is especially the case in commodity futures. We have our own futures fundamental model that we use that does a fantastic job of predicting environments of where the market is going to go based off of what's going on fundamentally. Future spreads are the second most important factor in that model. What future spreads do is they show the internal supply demand of the physical cash market. One thing we talk all the time is understanding why do markets exist. Markets don't exist for you, they don't exist for me. They exist for the commercial firms who use them to hedge and run their business. As such, future spreads are a representation of what's happening in the physical cash market. If the physical cash market, so if we're talking about something like soybeans or crude, this is the price that the actual soybeans or the actual crude is trading at between participants. If the physical cash market is strong, the futures are going to go up. If the physical cash market is weak, the futures are going to go down. Future spreads are excellent for showing where there is strong internal demand or strong internal supply in the cash market. The nearby futures contract will tend to have a tight correlation as to what's going on in the cash market. So that nearby futures contract will go up or down almost like a lever relative to the deferred months. And as such, it gives really great insights, tells as to what's actually going on in the market. We use this as an environmental filter. We talk about this a lot. There's environmental filters and there's tactical filters. Just because the future spread is strong and the futures are weak doesn't mean you should run out and buy the futures. But it does tell you that the futures market is ripe to rally. So you can be on watch for strength in the futures market to get long and go with the trade, being backed by what's happening in the future spreads themselves. This is also a fantastic tool, fantastic filter to help us know when to let our positions run and when to start to peel or hedge. So if we're long and the future spreads are confirming, or the future spreads are even stronger, we can hold, we can be patient, we can wait. But if we're long and the future spreads start to deteriorate, we know that the cash market is starting to weaken. And this is a great time to peel. This is a great time to hedge. A lot of times this is happening and people are not paying attention to it because the traders of the futures market themselves, they're so excited. Their positions are working and they become blind to what's actually happening in the cash market. Typically, commodities trade in what's called Contango. And this is where the nearby contract is cheaper than the further contracts or the deferred contracts. This is due to the cost of storage and financing. So if I'm going to take soybeans, I'm going to store them for 6 months and I'm going to deliver them 6 months from now. Well, I'm going to have to pay for storage and I'm going to have to potentially have to pay interest, or it's at least a loss on capital, cost of capital, for having to hold it for 6 months. So as such, soybeans 6 months from now should be more expensive to reflect storage costs and interest. This is normal, or what we call contango. But occasionally markets get into what we call backwardation or inverse, When the market goes into backwardation, the nearby futures contracts go up and they go over the deferred. And why is this? That's because there is strong urgency to get the physical product right now, to buy soybeans right now. Somebody needs them in this moment. They're not willing to wait 6 months. And so as such, they're willing to pay more now than they would 6 months from now. So watching spreads go from contango to backwardation and back to contango, or even relative moves within those, can give real insights as to what's actually going to happen with price. Now, there's several different ways you could look at these, but we're going to make this quite simple. In general, we like to use 3-month spreads. And so, in other words, we'll look at the front month versus the spread 3 months out or 4 months out. So we're going to look at an example here in a moment in cattle. We're looking at June, August. June is the front month. Then you'd have July. August is 3 months. So front month, 3 months. Some cases, they don't have that. Sometimes they're 4 months out. So you'll pick essentially a spread that represents the nearby contract and the next contract out, or about a quarter out. We do try and stay in the same season. If we do analyze between seasons, we need to understand that and we need to look at it differently. So right now, for example, this is June of 2025, and we're in the middle of growing season in agricultural products. So there's what we call a new crop, and there's an old crop. Old crop is the soybeans that are on hand right now. These are soybeans that were picked last fall, soybeans that were potentially picked this spring and maybe shipped up from Brazil or grown in the South, something like that. They're soybeans on hand. That's old crop. Then we have new crop. New crop is what's in the ground right now. So these soybeans and corn, they've just been planted. So the crop is still fresh. Those are going to be harvested in September, October, November. That's the new crop. So if we're looking the same season, we would be looking at old crop stops in July, August, maybe a little bit of September. So we could look at July, August, for example, that would be in the same season. Or if we went back a couple months, we could look at May, July, or March, May. Those would be in the same season. But once we get into fall, once you get to September, we start to cross over, November and December are the new crop. So if I look at July versus November soybeans, that would be an old crop, new crop spread, and that spread can really move. Now, it still gives a great sense of demand, but there are some factors that at times can make them act a little differently. Same thing with energies. Same thing with crude and nat gas. Nat gas is a big one. There's a future spread in natural gas called the Widowmaker. That's because it is blown out so many people. And that is the March-April spread. March is part of winter, April is part of spring. So now you have two seasons that are up against each other, and that spread can be incredibly volatile. But in general, just look at the front month, 3-month spread, and that'll give you a good sense of what's going on in supply-demand. So let's look at a few examples. This is currently what's going on in live cattle. On the left, we have the future spread. So this is June minus August. And you can see for a long time this year it was just within a range. But then when we got into May, it broke to new all-time highs. The spread did. And you can see it did make new highs back in February. But then it had a sharp correction when everything kind of went south with tariffs. It bottomed and it came flying back. And then what I want you to notice is that when it got up here, the spread went to a small range, almost like a flag or like a cup and handle. Okay, so you went into a small range, and here's the futures at the same time. So when we came off the April lows, this was a low in April. It had a strong low, rallied through March all the way into April. And that's when the spreads bottomed. The spreads bottomed in March. Futures bottomed in March. They rallied all through March into April. But then we got in early April, and the stock market was really getting clobbered. Live cattle futures, they sold off pretty hard. But the spreads didn't go anywhere. They went into a range, and they went sideways. What this told us is the market had underlying strength. And if we saw any strength in the futures market, the market was likely to go up a lot. So this is a divergence. Future spread stayed strong, price sold off. Well, down in here, we get a really good price action reversal, and then we take it out, and then look at it. The market just runs, and the future spreads are confirming it. Now, what's interesting is in late May, the futures have gone into a trading range, but the spreads have continued to go up. That's telling us there's still more bullishness in the market. Now, futures are rolling, and this could be part of it, but it's telling us the same thing. The futures, the cash market is stronger than the futures. So if we got a breakout up, that would be a breakout we'd be interested in pursuing because the future spreads are validating it. All right, let's look at one more historical example. This is wheat during the Ukrainian war. And you can see wheat was super quiet. And then as we started to have rumors of the war, and then the war broke out, you could see the future spread in wheat just exploded, as did price. But what's interesting is you see price makes this violent top, and it's confirmed by the future spreads. The future spreads just collapse. And then you can notice it puts in this violent top, but then it trades in a range for a couple months, and while future spreads continue to drop. Then price tries to rally. Spreads rally a little bit, but not nearly as much. You can see price kind of makes a run at these highs. The spreads get nowhere near the highs at all. And so now we get a price action turn here that's again confirmed by the future spread, and then the market just goes relentlessly down for several months, again, backed by the future spread. The future spread goes all the way back to where it started. This is a great example. So this is relevant, highly relevant in commodities. Not so much in stock indexes or treasuries or foreign exchange. Those tend to be different factors. Those are really just based off of interest rates, carry, dividends, that sort of thing. But in commodities, this is highly valuable, and we use it all the time. We use this to find some monster trades, both to get in them and to know when to get out. So I highly recommend you take a look at these. And what day is it? That's right, it's Tuesday. But it's not just any Tuesday. It's Trader Tip Tuesday. And Trader Tip Tuesday, I come to you with information like today, how to read future spreads to trade futures better, that help you take your trading to an elite level. I'll see you next Tuesday.